Hey New Zealand, today we're going to look at interest-only mortgages. Now, what are interest-only mortgages and who actually benefits from them and who should totally avoid it? We're going to look at a few examples and get an understanding of when is it required and when to not use it. We're going to look at the way it's assessed. We're going to see why it's useful for property investors, or perhaps if you're constructing or renovating your place, and the cons of no principal being paid down. Let's get into it. Over here, we've got a client, let's say they've got an 850K mortgage. It's fixed at 5.49% on a 25-year term, and they pay weekly $1,200 to the bank on principal and interest. Now, when I select interest only here, what will happen is that this repayment will drop to $897 from $1,202 per week. Now, that's a significant benefit, but there is a con. The way this is being calculated is literally 5.49% of the loan amount. This is the amount that you'll pay annually, and then your weekly will just be this figure divided by 52. So that's how the calculation works on interest only. Now, the way it's assessed is that if you have an $850,000 mortgage and you go to the bank and you want to get interest only, the bank will ask, how long do you want interest only? Interest only periods can range from 6 months all the way to 5 years at one bank. And that's the interest only period that you've got. That's not the fixed term. That's how many years you can have interest only, but you can fix for 1 year, 18 months, 2 years, whatever you want to fix for. Now, when the bank is assessing your interest only mortgage, they will put on the amount of interest only years that you want deducted from the term they're testing at. In my previous video, I looked at how mortgage borrowing is tested. Right now, it's assessed at 7.6% interest rate. That means you're not going to pay the bank 7.6% as a fixed rate mortgage repayment, but you are going to be assessed on that interest rate to ensure that you can stay on top of your payments in case interest rates were to rise up. So if I change this to 25 years, that would mean that the bank is now assessing interest only for 5 years for you, and they will look at your P&I repayments over a 25-year term. So obviously they assess you a little bit more harsher or strictly than they would for a normal principal and interest repayment. This wasn't always the case, but ever since the triple CFA reform happened back in COVID, this policy has still remained with the banks. Now, when you look at this repayment and you see, oh, okay, cash flow wise is actually beneficial for me. But what tends to happen is on an $850,000 mortgage on a 25-year term, assuming you're starting this mortgage off on the 30th of March 2025, and you're on 5.49%, you can see over here the principal is being paid along with the interest. Now, what will happen is that essentially this will get wiped out and you will only pay the interest. To give you an understanding again, this figure times this rate, I divide this by 12, it's going to give me the repayment of interest only. So what the con is that your mortgage balance actually doesn't drop. So its pro is cash flow, but its con is obviously principal debt not being paid down, which is a massive thing because you do want to pay principal down because that will allow you to build equity as well as having a smaller loan amount at the end of the next sort of 5 years or 3 years. So who does this actually benefit? Well, we're going to go into an example now and have a look at exactly who benefits from this sort of product. Now, let's say you want to buy an investment property for $700K. Let's assume it's a new build. Now, for this, you would have topped up 20% on top of your equity that you have in your current home. So 140K would have been your top up. And then basically, let's say you have $40,000 in cash savings, right? So you come to us as a client, you say, okay, I want to buy a new build. I have a bit of equity in my property. I saw this one down in Auckland for $700K. It rents out for $700 per week. How would I stack it up to be cash flow neutral? You've got 40K cash as well that's not being utilized, but you want to keep your cash on hand. Now, what that would mean is that you would borrow $700K, 100% finance from the bank on a 30-year term. Let's say you're sticking with the 4.99 rate at 2 years. It's being offered by the banks right now. The bank is going to charge you $865.59 per week for this mortgage. And your rent that's coming in is $700. Assuming rates are $2,500 a week, insurance for landlords, round about that $2,000 figure, The cost of insurance and rates per week is about $86.54. Now, if you are fortunate enough to be close by your investment property that's a new build, essentially you can self-manage. Now, if you're self-managing, that means you don't have a property manager and you are negative or out of pocket by $252.13 per week. Now, this $865.59 that we've got here is on principal and interest for the repayment. But if I was to change this to interest only, I will simply do the same thing again. And now I've got $671.73. So let's plug this in and see what happens. Now you can see you're negative by $58.27, which is a lot more digestible than negative $250. But you still want to give yourself the edge of being neutral. So then we'll look at your mortgage structure. And now let's erase this. Let's say you're wanting to borrow $700K from the bank and you are wanting to fix it on 4.99 and you're on interest only. Now remember that little bit of cash that you had on hand? That's probably going to come in handy now because you can offset. So offset is a whole different product that I will explain in other videos, but essentially you will be not paying repayments for interest and principal on the 40K out of the 700K on the mortgage. You still have access to that money, but if you tap into that money, you will be charged interest on the portion you take out. You take out $2,000, you'll be charged a floating rate for $2,000 until you top it back up. So if I put 40,000 in here as an offset, because remember in this example, we looked at the $40,000 cash that you've got on hand that you want to put to some good use. Now, if you put that in here and have a look, you'll see that your weekly repayment has dropped to $633. Now, if I plug this in here on the repayment calculator for the investment property, then essentially you're negative $19.54. So this is as close as you could get to being close to neutral. In this case, you might be considering interest only as a property investor. Now, when it doesn't help is when you are a homeowner that doesn't want to invest into property but has a little bit of a pickle in life and you want to look at interest only. If you can avoid it, please do, because it's always good to pay down principal debt on your family home. With that being said, that's pretty much the only sort of rationale behind interest only. In other cases where you'll use interest only would also be in scenarios where, let's say you are building or renovating. So in these cases, the bank knows that cash flow might be tight and you're going to have progressive drawdowns, meaning that the bank is topping up your mortgage as soon as you provide them the invoices. Framing is done, concrete is laid, roof is on. All those progressive payments will be stacked up on interest only to benefit you cash flow wise because it's not earning you an income yet. So you would consider being on interest only for that basis. So to summarize this video, essentially interest only is really good for property investors that are cash flow negative and they want to stay neutral or close to the neutral amount per week. But it shouldn't be used as a way of skipping repayments. Essentially, if times are tough, you're on maternity or you're constructing a minor dwelling or renovating your house, you can use it temporarily, but the best bet is to always do principal and interest. Hopefully that helps. If you want to know more, please jump onto the Blueprint Finance webpage, and we've got all the tools there along with content to help you understand why property investors or why you'd use interest only, along with a lot of other fundamentals for the mortgages. Hope you enjoy this video. Please subscribe. If you want any tools or you want some spreadsheets, reach out to us. We love giving away free stuff and we'd love to talk to you.